The topic for the National Life Insurance exam today is beneficiary types and designations, including the specific ways death benefits are distributed and how those choices impact policy ownership rights. You will frequently encounter questions that test your understanding of the hierarchy between primary and contingent beneficiaries. The primary beneficiary is the first person or entity designated to receive the death proceeds upon the insured passing. It is crucial to remember that there can be multiple primary beneficiaries, such as 3 children, each receiving a 1/3 share. The contingent beneficiary, who is often referred to as the secondary or successor beneficiary, only receives the proceeds if the primary beneficiary has died before the insured. If a primary beneficiary is alive at the time of the insured death, the contingent beneficiary receives absolutely nothing, regardless of their relationship to the deceased. A common trick on the exam involves a situation where the primary beneficiary dies shortly after the insured, but before the claim is paid. In most standard cases, the money would go to the primary beneficiary estate, but this is where the Common Disaster Clause becomes vital. This clause usually follows the Uniform Simultaneous Death Act, which states that if the insured and primary beneficiary die in a common accident and it cannot be determined who died first, it is legally assumed the primary beneficiary died first. This legal fiction ensures the money goes to the contingent beneficiary instead of the primary estate. Many policies add a specific time element, such as 30 or 60 days, where the primary must outlive the insured by that duration to collect the proceeds. When analyzing exam questions about the Common Disaster Clause, pay close attention to the time frame. If the policy specifies a 60-day survivorship clause and the primary beneficiary dies on day 59, the proceeds still go to the contingent beneficiary. This is designed to keep the death benefit out of the probate court of the primary beneficiary estate, which saves time and money for the heirs. Moving on to the rights of the beneficiary, you must distinguish between revocable and irrevocable designations. Most life insurance policies are written with revocable beneficiaries, which allows the policy owner to change the beneficiary at any time without needing their permission or knowledge. However, if a designation is irrevocable, the beneficiary gains what the exam calls a vested interest in the policy. This means the policy owner cannot change the beneficiary designation or even take out a policy loan or assign the policy without the written consent of the irrevocable beneficiary. If you see a question asking who must sign off on a change to an irrevocable policy, the answer is always the beneficiary because they have co-owner-like rights. A great way to remember this for the exam is the phrase irrevocable means I require consent. You should also be prepared for questions regarding the policy owner flexibility. While a revocable designation keeps all power with the owner, the irrevocable designation is often used in divorce settlements or business agreements to ensure the money goes exactly where intended, regardless of future changes in the owner mind. Another area of confusion is the difference between per stirpes and per capita distributions. Per stirpes means by the root, and it ensures that if a beneficiary dies, their share passes down to their living children, while per capita means by the head, and it distributes the money only to the named beneficiaries who are still living. Always look for keywords like vested interest when dealing with irrevocable beneficiaries, and look for the sequence of death when analyzing common disaster scenarios. If the primary beneficiary is even slightly alive after the insured, and there is no common disaster provision in place, the money goes to the primary estate, which is a common exam trap you must avoid. If the question asks why an owner might choose a contingent beneficiary, the most accurate answer is to provide a backup plan and avoid the proceeds falling into the insured estate, where they would be subject to creditors and taxes. Finally, remember that naming a minor as a direct beneficiary is a mistake because insurance companies cannot pay funds to minors directly, which requires a trust or legal guardian to be established.